Welcome to the deep dive. We're here again, digging into the sources you send our way to find those crucial insights. And wow, that clip we just heard from Coin Bureau, it really makes you stop and think, doesn't it? Could something as well quiet as population decline actually be a bigger threat than, all the major crises we hear about constantly? Nuclear war, climate change, it feels counterintuitive, right? But that's exactly what we're going to unpack today based on the material you shared. Now, when we say demographic decline, I think a lot of people still picture the old idea, the population bomb. Too many people, strained resources. But the sources, especially that Coin Bureau piece, are painting a really different picture. The real issue, the sort of stealthy threat, is the opposite. Fewer people being born, populations getting older, and actually shrinking. It's like, imagine this huge economic engine, okay, for generations. It's been fueled by constant population growth, more workers, more consumers, always expanding. But now, imagine that fuel line is slowly getting squeezed,
Yeah.
constricting. The engine isn't just going to stop dead. It's going to sputter, its whole rhythm is going to change, and that could transform everything around it. So today, we're diving deep into these sources, particularly that Coin Bureau video, to figure out why this quiet trend matters so much, what's driving it, and how it's already kind of reshaping our financial future.
It really is fascinating, and you're right, it's incredibly pervasive. This issue is quietly weaving its way through pretty much every economy, every society around the globe. But it gets overshadowed, doesn't it, by the more dramatic, immediate headlines.
Yeah.
So people tend to overlook the sheer scale of the long-term impact. Our job today, really, is to pull out the most critical insights from all this material you've given us. We want to help you understand what this massive structural shift actually means. For you, personally, for the economy, and, well, for society as a whole.
Yeah, it's funny how ingrained that population bomb idea was. I remember seeing stuff about it back in the day. This fear of an overcrowded planet, resources just running out, food, water, everything stretched thin. It was all about scarcity because of too many people. Like something out of Malthus.
Exactly. That was the dominant narrative for, what, decades. But the research we've looked at, the projections coming out now, it's a complete U-turn. We're talking about projections from big institutions, the European Commission, even top medical journals like The Lancet. They're all pointing the other way now. The real crisis isn't runaway growth. It's the opposite. Populations are shrinking. And it's happening faster than most people think.
Faster? How much faster?
Well, think about the old estimates. Just a few decades ago, people were talking about maybe 12 billion people by 2100. That was the number thrown around. But the new estimates, they're suggesting the global population might peak much sooner, maybe around 9.7 billion, and possibly as early as the 2060s. Then after that peak, a sharp decline, not just leveling off, but actually shrinking year after year. It's a huge revision, a totally different trajectory for humanity.
Wow, okay, so it's not just theory, it's based on what's happening now.
Precisely. You can see it already playing out. Japan is the classic example, right? The canary in the coal mine. They've been dealing with population decline for decades. It's not just numbers on a chart. You see empty schools in the countryside, a huge proportion of elderly people. It's a real, visible thing.
And it's not just Japan, you're saying?
Oh, not at all. Look at South Korea. Their birth rate is, well, it's astonishingly low. Something like 0.72 births per woman. Think about that. Less than one child per woman, on average. Imagine what that means for the next generation. School classes half empty, workplaces struggling to find young staff. It's stark.
0.72. That's incredibly low.
It is. And Europe. Many countries there are in a similar boat. Italy, Spain, loads of places consistently below fertility rate of 1.4. Again, that's way below what you need just to keep the population stable. They're facing serious challenges with pensions, healthcare for the elderly, economic dynamism, and even China, until recently the most populous country on Earth. Now, it's shrinking too. That's a massive shift, partly due to their past policies, but also modernization.
So what's the magic number then, the rate needed to keep things stable?
Yeah, that's called the replacement rate. Generally, it's accepted to be around 2.1 children per woman. That little 0.1, that fraction, accounts for things like children who don't survive to adulthood. So 2.1 means each generation roughly replaces the previous one. And as you can tell from those numbers, 0.72 in Korea, below 1.4 in much of Europe. Many developed nations are way, way below that 2.1 mark. It creates this sort of demographic spiral downwards.
Okay, but aren't there parts of the world still growing? Africa, for example?
Yes, absolutely. Sub-Saharan Africa, parts of South Asia, populations are still increasing there. That's true. But the projections suggest that even these regions will eventually see their fertility rates fall as they develop, and their population growth will slow and likely reverse later on. It seems to be a pattern linked to economic development and social changes. But the immediate issue, what's crystal clear right now from the sources, is that the West Europe, North America, Japan, Korea is in pretty significant trouble, demographically speaking. The decline is here, and it's accelerating.
Okay, so the world isn't exploding, it's imploding, almost, at least in many key regions. If this decline is the real doomsday, as Coin Bureau put it, what's actually causing it? Why this massive collapse in growth? It can't just be one thing, can it? Feels like there must be several big forces at play.
You're absolutely right. It's not one single cause. It's a complex mix, a confluence of factors that are all kind of pushing in the same direction, suppressing birth rates. Several big ones stand out in the material we looked at.
Like what? What's the biggest driver?
Well, probably the most fundamental one is just economics, plain and simple. Having kids has become incredibly, almost prohibitively expensive for huge numbers of people. Think about the costs. Housing, first off. Trying to find a place big enough for a family. In many cities, it's just out of reach. Then childcare. The costs are often astronomical, sometimes more than a mortgage payment. Education costs keep rising. Healthcare isn't getting any cheaper. It all adds up. One source mentioned the U.S. figure raising a child to 18 now costs, on average, over $310,000.
$310,000 per child. Wow.
Yeah. And that's often before you even think about college. Meanwhile, what's happened to wages for most people? Real wages, adjusted for inflation, have barely budged in decades. Stagnant. So you've got costs soaring and incomes flatlining. It's no surprise people feel they just can't afford to have kids, or maybe only one kid. The financial pressure is immense.
Okay, so economics is huge. What else?
Another major factor is, well, how society has changed. Social isolation is a big part of it. People just aren't forming the same kind of deep relationships or communities they used to. Families aren't forming in the same way. There were some striking survey results mentioned, like half of Americans reporting fewer than 3 close friends. Over 10% with no close friends. That's concerning.
That is concerning. Less support, maybe.
Exactly. Those community bonds, the local networks that used to support families, they've weakened, and they've often been replaced by, digital connections, social media, which ironically seems to be making a lot of people feel more lonely, more isolated. And think about dating, finding a partner. Social media seems to offer endless choice, right? You can connect with anyone, anywhere. But the sources suggest this actually makes forming stable, long-term relationships harder. There's this constant pressure, this feeling that you're competing with everyone on the planet, that maybe someone better is just a swipe away. It kind of erodes the commitment needed for long-term partnership and, ultimately, family.
That makes sense. The paradox of choice. So economics, social isolation.
Yeah.
What else?
Then there are the shifts in gender roles and work. Women's participation in the workforce has obviously increased dramatically, which is fantastic social progress, absolutely long overdue. But it's had unintended consequences, economically speaking.
Yeah.
It used to be more common for one income, typically the man's, to be enough to support a family. Now, for most families, 2 incomes aren't just a bonus, they're essential, a necessity just to get by. That puts enormous strain on working parents, especially mothers, trying to juggle demanding careers, childcare, running a household. It's incredibly tough. It makes the decision to have children, especially multiple children, a much harder calculation. The time, the energy, the cost. It's immense.
Right, the second shift and all that. It's a huge burden.
Definitely. And finally, there's just this pervasive sense of uncertainty about the future. A lot of people look ahead and feel, pessimistic. They worry about the environment, climate change, what kind of planet their kids would inherit. They worry about economic instability, job security with AI coming, rising inequality, political polarization. This is kind of societal anxiety, maybe. And this gets amplified, doesn't it? By the 24/7 news cycle, social media constantly highlighting the negative, the scary stuff. All this creates anxiety, and it makes people hesitant to bring children into a world that feels so unstable and uncertain. It's a huge emotional barrier.
So it's this potent mix then. Crushing costs, feeling disconnected, the pressure of 2-income households, and just a general sense of unease about the future. These aren't just abstract trends. They're shaping the most personal decisions people make, adding up to this massive demographic shift.
Okay, so if that's why it's happening, let's connect it back to the bigger financial picture. How does this quiet decline start shaking the foundations of our economy, starting with something like pensions? Exactly. And this is where you really start to see the systemic impact. The uncomfortable truth highlighted in the sources is that our current financial system, particularly things like pensions, is fundamentally built on an assumption of continuous population growth. Think about how most pension systems work, whether it's Social Security in the U.S. or similar programs elsewhere. They're essentially pay as you go. The money paid in by today's workers isn't saved up in a vault for their retirement. No, it's used immediately to pay the benefits of current retirees. It works fine, or reasonably fine, as long as you have a steady stream of new young workers coming in to replace the older ones retiring. More contributors than beneficiaries, ideally.
Like a conveyor belt,
Yeah.
bringing in new money to fill out the old.
Precisely. But what happens when that conveyor belt slows down? When you have fewer young people entering the workforce and a huge bulge of older people retiring, like the baby boomers, the ratio shifts. Fewer contributors supporting more and more beneficiaries. That's why the Coin Bureau piece used the analogy of a Ponzi scheme. Not that it's intentionally fraudulent, of course not. But structurally, its viability depends entirely on a constant influx of new participants paying in.
So government's basically spent the money already, the contributions from today's retirees.
Largely, yes. The systems rely almost entirely on current contributions to pay current benefits. There isn't some massive trust fund sitting there covering everything for decades to come, despite what some people might think. So when the demographics shift like this, governments face a really nasty dilemma, an almost impossible choice. Option 1. Hike taxes massively on the shrinking number of workers left. But politically, that's incredibly difficult. It could stifle the economy, cause huge backlash. Option 2. Drastically cut pension benefits for retirees. Again, politically toxic. Imagine the social unrest if people who paid in their whole lives suddenly see their promised retirement security vanish. It breaks a fundamental social contract.
Neither sounds good, so what do they do instead?
Well, they often resort to, let's call them stealth tactics. Two big ones mentioned are financial repression and mass immigration. Financial repression sounds complicated, but the basic idea is governments, often working with central banks, keep interest rates artificially low, specifically below the rate of inflation.
Okay, so if inflation is 5%, interest rates might be held at, say, 1%.
Exactly. And what does that do to your savings? If your money in the bank or in government bonds is earning less than inflation, it's actually losing purchasing power every single year. In that example, your savings shrink by 4% in real terms. It's like an invisible tax. It slowly erodes the value of savings and debt. This makes it cheaper for governments to manage their huge debts, including those massive unfunded pension liabilities, without having to announce unpopular tax hikes or benefit cuts. It quietly transfers wealth from savers to the government.
And this is actually happening.
Oh, absolutely. Japan is the prime example again. Oldest population, massive pension obligations, public debt, over 250% of GDP. What do? Ultra low, sometimes negative, interest rates. Savers earn basically nothing or even lose money nominally. It's financial repression in action, helping the government manage its debt burden by inflating away its value. And the sources warn, don't think Japan is some isolated case. Europe, North America, they're on very similar paths, just maybe a few years behind. Central banks keeping rates below inflation for long periods. That's partly why.
Wow. Okay, so that's financial repression. What about immigration?
Immigration has been the other go-to strategy, particularly in the West. The thinking is, if your own population isn't having enough kids, you can import younger workers from other countries. These new workers pay taxes, contribute to pension systems, and help fill labor shortages, propping up that pay-as-you-go model for a bit longer. But as we're seeing increasingly, this isn't a simple fix either. Relying on large-scale immigration is causing significant political friction, isn't it? We're seeing pushback, rising nationalism, debates about integration, social cohesion. It's triggering major political backlash in many countries. Governments are caught between the economic need for workers and the social and political resistance to large-scale immigration. It's becoming a really difficult balancing act.
So if raising taxes, cutting benefits, financial repression, and immigration all have serious downsides or limits, what's left?
More debt, unfortunately. That's often the path of least resistance politically. Governments issue more bonds to cover the shortfalls, basically borrowing money to pay current pension benefits, kicking the can further down the road. But then you have another problem. Who buys all this new government debt? Especially if interest rates are being kept artificially low. This can lead to another form of financial repression, where governments subtly pressure domestic institutions, banks, their own pension funds, insurance companies to buy government bonds, even if the yield is terrible, lower than inflation. These institutions become captive buyers, forced to hold government debt that loses real value, which ultimately hurts the savers or pensioners whose money they manage. It's a hidden way to fund the gap.
Okay, a pension situation sounds precarious, to say the least. But this demographic shift must affect more than just government finances, right? This is where it gets really interesting for everyday investors. What about asset prices? What does this mean for the stock market?
That's the next critical piece of the puzzle, absolutely. Think about those huge pension funds we just discussed and other big institutional investors like insurance companies. They manage trillions of dollars, and a massive chunk of that money is invested in the stock market. A lot of it flows in passively through index funds. These index funds basically operate like, well, the source called them large mindless robots. They just buy stocks based on their weighting in an index, like the S&P 500. They don't really care about the price or the company's fundamentals. They just buy because the money keeps flowing in. This constant systematic buying from pension funds and other passive investors has been a huge tailwind for stock markets for decades, pushing prices up.
Okay, so constant inflows push prices up. What happens when the inflows slow down?
Exactly. That's the problem. With fewer workers contributing and more retirees drawing benefits, the net inflow of money into these pension funds starts to shrink. Eventually, it could even reverse, becoming net outflows. That means less money automatically flowing into those index funds, less of that mindless buying pressure. So, major stock markets, which have become really dependent on this continuous flow of capital and on assumptions of endless consumer growth, could face serious headwinds, significant downward pressure. And if stock prices fall or even just stagnate for a long time, that hits retirement savings hard. Pension funds might struggle to meet their obligations. People's 401ks or personal retirement accounts shrink. It could mean real economic pain for millions of retirees who are counting on those assets. It's all interconnected.
Right, so the picture seems pretty challenging. Strained pensions, potential pressure on markets. It sounds quite grim. But here's a twist. The sources also suggest that this whole situation might be setting the stage for something potentially positive, at least for some people. This idea of a great economic rotation power shifting away from capital back towards labor. That sounds like a huge deal. What does that actually mean in practice?
It is a huge deal, and potentially one of the most significant, maybe even overlooked, consequences of this demographic shift. To get it, let's just quickly step back.
Yeah.
For the last, say, 30 or 40 years, the global economy has been heavily tilted in favor of capital. Think big investors, multinational corporations, the owners of assets. They held most of the cards. Why? Mainly because there was an abundance of labor globally. Globalization opened up huge new labor pools in places like China, India, Eastern Europe. Companies could easily move production, outsource jobs, play workers in one country off against workers in another, always seeking the lowest possible wages. This gave corporations immense leverage. They could suppress wage growth even while their productivity and profits soared. Workers, facing global competition, had very little bargaining power. The result was stagnant real wages for decades for average workers in developed countries, while wealth concentrated at the top. Capital won. Labor didn't really share in the gains.
Okay, so that was the era of abundant, cheap labor. How does demographic collapse change that?
It flips the script completely. Suddenly, that seemingly endless supply of cheap labor starts to disappear. You've got fewer babies being born, meaning fewer young people entering the workforce down the line. At the same time, you have this massive wave of baby boomers hitting retirement age and leaving the workforce in droves. So the supply of workers shrinks dramatically. But demand for workers, at least initially, remains relatively strong. What happens then? Basic economics. Corporations suddenly find themselves competing fiercely for a smaller pool of available workers. The power dynamic shifts.
Is this actually happening yet, or is it still theoretical?
It's already happening, quite dramatically in some places. Japan, again, is the leading indicator here. Because their labor shortage is so acute, wages have started surging in ways they haven't seen in decades. The sources mentioned some Japanese companies giving out huge pay rises, like almost 10% in a single year. That's massive after years of deflation and stagnation. And people switching jobs, they were getting average raises of over 40% in some cases. Because companies are desperate to attract and retain staff. They're not doing it out of kindness. They're doing it, as the source put it, to survive. They have to pay up, offer better conditions, or risk simply not having enough workers to operate.
Wow. So Japan is the extreme case, but you're saying we're seeing hints elsewhere.
Exactly. Similar trends are quietly emerging, as the source said, across Europe and North America too. After decades where employers held all the power, employees are finding they have more leverage. They can demand better pay, better conditions, more flexibility. This rising power of labor is actually a big reason why governments in the West have been pushing immigration harder lately. They're trying to counteract these labor shortages and keep wages from rising too quickly. But as we said, immigration has its own limits and problems. And crucially, even the big outsourcing hubs are changing. China, India. They're facing their own demographic headwinds now. Aging populations, falling birth rates there too, so companies can't just easily shift production somewhere else cheap anymore. Those demographic walls are going up everywhere. The global labor arbitrage game is ending.
Okay, but what about robots? AI. Isn't technology supposed to replace all the workers anyway?
That's the common assumption, right? But the sources argue, quite strongly, that we're not there yet. Not even close for many jobs. Yes, automation and AI will definitely impact certain sectors, especially routine, repetitive tasks. But current technology is nowhere near advanced enough to replace the complex, nuanced skills needed in a huge range of jobs. Critical thinking, creativity, emotional intelligence, complex problem solving, skilled trades, the list goes on. So, for the foreseeable future, companies still need human workers for most roles, which means they face a choice. Adapt to this new reality of higher wages and worker power, or face shrinking operations and falling profits because they simply can't find the staff. The old playbook of maximizing profit by minimizing labor costs just doesn't work anymore when labor is scarce.
Yeah.
Higher wages become a necessity, not a choice.
So this shift towards labor could be quite long-lasting then.
It seems likely. This isn't just a temporary blip, it's a structural shift driven by deep demographic trends. Demographic collapse is kind of inadvertently forcing a rebalancing of the economic playing field. It's giving labor more power than it's had in generations.
And you mentioned a feedback loop. How does that work?
Yeah, this is interesting. So, as wages rise, what happens? Well, suddenly having a family might seem more affordable again for more people, right? It eases that economic pressure we talked about earlier. So rising wages could potentially encourage slightly higher birth rates or at least stop the decline from worsening quite so fast. But at the same time, if more people start families, especially if one parent, often the mother, steps back from the workforce for a while, that can further tighten the labor market in the short term. So you get this potential cycle. Rising wages makes family formation more viable, might slightly increase family size or workforce exit, creates more labor shortages, drives wages even higher. Eventually, the market would find a new equilibrium. And perhaps decades down the line, if labor supply recovers and technology advances sufficiently, power might slowly swing back towards capital again. These things tend to be cyclical over the very long term. But the key takeaway is that these are huge, slow-moving shifts. They take decades to play out fully. We're only in the early innings of this transition back towards labor having more power.
Okay, so we have this massive demographic shift, and it's fundamentally changing the balance between labor and capital. Pensions are strained, markets might face headwinds, but workers might gain power. Which leads to the really big question, the one hanging over all of this. Can capitalism, the system we have now, actually cope with this? Can it adapt to a world that isn't constantly growing its population?
That is the multi-trillion-dollar question, isn't it? And the sources really wrestle with this. On the one hand, you look at history, and capitalism has been incredibly resilient. It's faced world wars, depressions, technological revolutions, and it's always managed to adapt, reinvent itself, and usually emerge stronger, albeit changed. But the argument here is that this demographic challenge is fundamentally different. It's unlike anything capitalism has faced before.
Different how?
Because, at its absolute core, capitalism as we know it thrives on growth. It needs expansion, more workers to produce things, more consumers to buy things, growing markets to justify investment and generate returns. That constant expansion has been the underlying engine for centuries. When populations start shrinking, you lose that fundamental driver. You lose the automatic expansion of workers and consumers. And this isn't just a temporary dip like a recession. The sources stress this is structural. It's long-term. It changes the basic operating conditions of the system.
And you mentioned companies maybe aren't innovating as much, that techno-feudalism idea.
Right. That's another layer to this. The argument is that many dominant corporations today, especially big tech, haven't been focused on truly groundbreaking innovation that creates entirely new markets or dramatically boosts productivity across the board. Instead, they've become incredibly good at using their scale and network effects to dominate existing markets and extract rents. Think app store fees, online advertising monopolies, controlling e-commerce platforms. They profit by controlling the digital infrastructure and taking a cut, rather than necessarily inventing the next huge thing. It's more about optimizing extraction from the current system. This model worked fine, maybe even brilliantly, when the number of users and the overall economic pie were constantly growing due to population increases. It masked a potential lack of deep innovation. But what happens when the user base stops growing, or even shrinks, when the pie isn't automatically expanding? Then, relying on rent extraction alone leads to stagnation. These companies will be forced to either innovate in genuinely transformative ways to create new value or face a future of much slower growth, possibly even decline.
And consumer behavior changes too, right? With an older population.
Massively. It's not just that older populations spend less overall, although that's generally true and reduces aggregate demand. They spend differently. Less on discretionary stuff, maybe fewer new cars, less trendy clothing, less eating out, more on essentials, particularly healthcare, pharmaceuticals, retirement living, home modifications, maybe travel geared towards seniors. This forces a huge shift for businesses. Companies built on selling stuff primarily to young people or relying on constant consumption growth will struggle. Industries catering to the needs of an aging population will likely boom. It requires a major pivot for many sectors.
And productivity isn't picking up the slack.
That's another worrying piece. Historically, even if population growth slowed, rising productivity, getting more output per worker through technology and efficiency, could keep the economy growing. But the sources point out that productivity growth in many developed countries has been disappointingly slow for years now. It stalled, ironically, just when we need it most to compensate for fewer workers. Without strong productivity growth, a shrinking workforce almost inevitably means a shrinking economy, or at best, stagnation.
And all this ties into debt. You mentioned consumer debt earlier.
Yes, it exacerbates the debt problem significantly. We already have record levels of consumer debt, over $18 trillion total in the U.S., over $1 trillion just on credit cards.
Yep.
Much of this debt was taken on during a time of expected future growth. People borrowed, assuming their incomes would rise, that the economy would keep expanding. But in a shrinking, aging economy with potentially stagnant growth, servicing that massive debt burden becomes much harder. For individuals, for companies, and for governments, who's going to generate the future income to pay it all back if the workforce is shrinking and consumption is falling? It makes the whole system much more fragile, much more vulnerable to a debt crisis.
So it really does sound like capitalism is at a major crossroads. Adapt or what? Stagnate, collapse.
Adapt or face prolonged stagnation and instability. That seems to be the core message. To survive and thrive in this new demographic reality, capitalism has to reinvent itself again. This probably means significant policy changes. Governments might need to get serious about supporting families, affordable housing, universal childcare, better healthcare access, paid parental leave, things that make having children more feasible. It might also mean regulatory changes, perhaps getting tougher on monopolies and rent-seeking behavior, trying to steer companies back towards genuine innovation and investment, rather than just financial engineering or market domination. If the system adapts, if it becomes maybe fairer, more focused on long-term well-being and stability rather than just short-term growth at all costs, it could emerge stronger. But if it doesn't, if it stays locked into the old growth-dependent model, then we could be looking at decades of economic malaise, increasing social tension and political instability. It's a really pivotal moment.
Okay, that's a sobering look at the big picture, systemic challenges, the need for adaptation. So let's bring it down to the individual level. For someone listening right now, what does all this actually mean for them? For you, how should you be thinking about positioning yourself for this very different future?
That's the crucial takeaway, isn't it? How do you navigate this? First, I think, is a mindset shift. You have to accept that the economic environment of the next few decades is likely to be fundamentally different from the past few. The conditions that favored capital so heavily that led to stagnant wages for many, those are changing. We're moving into an era defined by labor scarcity, likely rising wages for many, and a significant shift in power dynamics. So step one is recognizing that shift and what it means for your own leverage.
More leverage as a worker?
Potentially, yes.
Yeah.
Significantly more in many fields. As companies struggle to find and keep good people, skilled workers are in the driver's seat in the way they haven't been for a long time. You have more bargaining power. Understanding your value in this new landscape is absolutely key. Don't undervalue yourself.
So what does that mean for career planning?
It means continuous learning is more important than ever. You need to actively invest in your skills, keep training, stay adaptable, and maybe think strategically about which skills and industries to focus on. Where are the biggest labor shortages likely to be? Healthcare, certainly, skilled trades, education, roles requiring complex human interaction or advanced technical skills that aren't easily automated. Positioning yourself in those high-demand areas maximizes your leverage and earning potential.
Okay, career strategy makes sense. What about investments? How do you invest in a world with shrinking populations and shifting power?
It definitely requires a different lens. The old strategy of just buying a broad market index fund and assuming it will go up forever because of constant growth, that might be less reliable. You need to think more strategically. What kinds of companies are likely to thrive in this environment? Well, maybe companies that are good at attracting and retaining talent. Those that offer competitive wages, good benefits, flexible work, maybe family-friendly policies. They might have a competitive advantage through higher productivity and lower turnover. Also, think about the sectors likely to benefit from government policy shifts aimed at supporting families or dealing with an aging population. Affordable housing developers, childcare providers, healthcare innovation, elder care services, those could be areas of significant investment and growth.
And you mentioned geographical diversification earlier, too.
Yes, that becomes even more important. This demographic decline isn't hitting every country equally or at the same time. Some nations might manage the transition better than others, maybe through proactive family policies, successful immigration integration, or fostering innovation. Investing solely in one country, especially one facing severe demographic headwinds, could be risky. Spreading investments across different regions, different demographic profiles, helps mitigate that risk.
So maybe less passive investing, more active choices.
Potentially, yes, or at least a more discerning approach. As we discussed, the huge flows into passive index funds might slow or reverse, putting pressure on those big benchmark indices. This doesn't mean ditch passive funds entirely overnight, but it does mean you should probably think more carefully about which sectors and companies are well positioned for this new reality, rather than just assuming the whole market will rise uniformly. Active management, or at least strategically chosen sector investments, might become more valuable.
And finally, what about just basic financial planning? Pensions, retirement?
Absolutely critical. Given the stresses on government pension systems we talked about, you probably can't rely on them as much as previous generations did. You need to plan for different scenarios. What if state pensions are less generous? What if retirement ages keep getting pushed back? That means taking personal responsibility for saving and investing for your own retirement is paramount. Diversifying your retirement assets may be beyond just stocks and bonds, considering things like real estate in resilient areas, ensuring you have flexibility. It's about building your own financial resilience in an uncertain future. Look, the landscape is changing, no doubt about it. It might feel unfamiliar, even unsettling. But by understanding these shifts, by positioning yourself strategically in your career, with your investments, in your planning, and by staying adaptable and informed, you can absolutely turn this uncertainty into opportunity. Knowledge in this transition really is power. Hashtag outro. And maybe this leaves us with a final thought to chew on. If the traditional capitalist model, so dependent on endless growth, is being fundamentally challenged by these demographic realities,
What kind of society, what kind of economic framework might actually emerge from the reinvention that seems necessary? And just how much creativity and human ingenuity will we need to redefine what prosperity even means in a potentially smaller, older world?
That's a deep question and a perfect place to leave it for today. A reminder that change brings challenges, but also the possibility of building something different, maybe even better. We really hope this deep dive gave you a lot to think about. If it sparked some aha moments, maybe challenged some assumptions, please do follow, like, and share it with anyone else you think might find it valuable. And if you're curious about how governments might try to dig themselves out of that pension hole we discussed, we actually have a whole separate deep dive focusing just on that complex issue. Definitely check that out. For more insights and analysis from us, you know where to find us. Be sure to follow What Bitcoin Taught Me on Twitter X, Nastar, Bluesky, Threads, Instagram, Facebook, and LinkedIn. Thanks again for joining us for the deep dive. We'll catch you next time.